Welcome back to the Living Markets, everybody. Let's talk more about the Chinese market and Alibaba's Singles' Day sales frenzy now with Catherine Yeung. She's an investment director for Fidelity International based in Hong Kong. Thank you so much for joining us again, Catherine. Before we talk Alibaba, let's talk about SoftBank's mega IPO. $21 billion is expected. It's probably going to be the second biggest IPO after Alibaba. What kind of investor appetite do you see?
Well, it'll be very interesting because SoftBank is such an iconic brand. Song Sun himself is such a visionary CEO and founder. And what they're really banking on is, in fact, the payout ratio, roughly speaking, 85%, which translates into, when we look at the IPO price, about a 5% dividend yield. So this could very much attract investors.
Now, when we talk about Alibaba, that was the big event of the weekend, of course. Online sales jumped by 27% compared to last year, reaching some $30.8 billion. Not bad. Did you expect something like that?
In honesty, yes. When we look at that gross merchandise value, you know, once again, it was bigger than the combined sales of Black Friday in the US and Cyber Monday. But what's worth pointing out is that the 27% year-on-year growth is lower than, for example, last year, which was up 39%. So we are seeing somewhat of a slowdown as penetration almost peaks.
It is slowing down in the 10-year history of the Alibaba Singles' Day. So do you think that the shopping party is almost over now?
I wouldn't say the party's over. And what was interesting about this recent Singles' Day is, again, testing the infrastructure, so the logistics behind the delivery mechanisms, breaking down the analysis. So 40% of sales were actually international brands, Japanese, Australian, etc. And also, what's also worth noting is that 46% of the users or the shoppers were post-90s. So the millennial impact's really making a difference in terms of how Chinese and the consumers shop.
Which international brands do you see selling especially well, and maybe even some of the Swiss luxury watchmakers or so?
Well, off the top of my head, definitely the luxury brands, and there really isn't any other competition within China. But we are seeing some consumer staple brands gain a lot of traction, whether it's related to food, for example, or beverage. So again, if you are unique, you can't get that product in China, you've got a good brand, they're the ones that kind of the consumers are gravitating towards.
Now, Alibaba's number of monthly mobile active users are some 666 million people out there. That's double the US population, for example. But as we mentioned, demand seems to be softening in China. Is this because of the US-China trade war or the domestic economic slowdown in China?
Well, it's also about penetration really has hit this sort of peak, so to speak, or sort of plateauing out. But Alibaba, when you look at the management, when you look at the various businesses they're in, yes, e-commerce is their main cash cow, but they're in cloud, they're in big data. You know, in China, you can't do anything without cash or device payments. So it's just one aspect of their business, and it's such a big name now in China.
So do you believe that the diversification of the business model is actually helping them to weather the storm of a slowdown?
Definitely, and even the share price in Tencent, which has slumped year to date, again, their gaming platform is what they're known for, but like Alibaba, they have Tenpay, which is an online payment system, and other areas of the business. And again, just such a big name now within China.
But Alibaba's stock has dropped some 14% last month. Today, again, some 6% together with other tech stocks. What's your take on Alibaba shares?
Well, Alibaba, again, a bit like Tencent, they're a long-term growth compounder. And when we looked at the rally last year in China, it was really driven by tech, by a couple of property names. So not surprising that we are seeing some profit-taking. Earnings are likely to be revised down further both in 2019 and 2020, really as a result of maybe they were a bit too high going into 2018.
Now, talking about consumer and tech stocks, where would you put your money right now? Is it still the Alibabas and the Tencents and NetEase, JD.com, or would you go maybe for more smaller caps as well?
It's all about earnings visibility. And what's really interesting is with this sell down we have seen in China, you could either gravitate towards the fallen angels, so consumer tech names, especially that are listed in the mainland, but also what we are still firm believers are the old China names. So names which are paying an interesting dividend, who've got good free cash flow yield, who are sort of the winners in unloved sectors, be it steel, cement, etc. So really having a broad-based exposure to the long-term winners in China makes a lot of sense in this environment.
This massive sell-off that we have seen in the market today, especially among global tech names as well, do you see a lasting impact globally and maybe also on Chinese names that you're mentioning now, or is this just a short drop?
Well, again, if your names like Ali and Tencent, who have this earnings visibility, seeing the current valuations and the fact that they've been sold off, it was very much a consensus of trade, actually does provide some re-entry points. So again, is it the winners take all? Who has sort of the market share? So even with when we look at Alibaba's, Singles Day sales, JD, they didn't even come close to what Ali has. So it's again, who dominates the market, especially when it comes to the consumer in China.
On Friday, the Chinese securities regulator announced that it will be possible for companies to buy back shares. Do you see this as a big move, and is there more to come?
The government's really focusing on sentiment in China, and the risk actually for the fourth quarter is that they overstimulate. So we are expecting to see more and more fiscal type of accommodative or loosening policies being introduced, whether it's this buyback scheme, whether, for example, the banks are being asked or instructed to loan more to the private sector, just to lift that sentiment and to boost that capex cycle that we really haven't seen come through, probably as a result of negative sentiment because of the trade issue.
The big next event on the Chinese calendar is the Central Economic Work Conference in December. Do you expect more opening up there, maybe even in the A-shares market, which is still off limits to foreign investors?
Well, the pace of inclusion in terms of A-shares into MSCI is quite an interesting thing to watch. And President Xi Jinping, when we look at the IPO pipeline, yes, we've seen about 30 Chinese tech companies list on NASDAQ or New York, but we are seeing a growing bias towards shifting the listing in Hong Kong. And Xi Jinping has announced that he's looking to, news is yet to be finalized, but looking to create a new tech board on the Shanghai Stock Exchange to have sort of easier ways of listing for companies.
We'll definitely watch that space. Thank you so much for joining us, as always, Catherine, and have a good trip back to Hong Kong.